Okay, thank you. So I prepared two topics today. One is showing you the charts and explain you the logic, and another one is trade messages. So when we send the trade message, you don't see voice. Do you hear me? I think we might have to dial in. Correct? Can you? Are you guys hearing me or not? If you don't hear me, how you say no? I don't hear you. Okay, can see and hear. Okay, good. Okay, thank you, thank you. So I don't know. Somebody said no, I cannot hear you. So how can you tell me? Okay, all right. So I start. I apologize. This is something new happened. So I'll start with the charts and show you the logic. So what I'm trying to show via charts that trading is not that difficult. For them, it's a common sense most of the time, or it comes from the skills. So I'll show you what I see uh, during the market, and I'm sending out the trades and the logic behind, and see if it makes sense to you. And then later I'll explain the trade messages. So how when we send out the message, like buying to open, so when initiating the trade, or the targets are sent, and then the updates are sent. So what those three targets mean? We have three targets: green, yellow, and red. The updates. So why I'm sending the updates, and then closing the trade. So the closing have different messages: partial close, or complete close, or majority of the close. So I'll explain all that. So we are already behind. Let me start quickly. Okay. So here's the chart of ACB. So I'm showing you the logic. So you see, so there's a certain pattern, and you will see what I'm trying to explain. There's a certain pattern which repeats itself, and I look for it, and then I take my chances. So it's like stacking your odds in your favor, and then go for it. So no audio, I can see the screen, can even see your mouse. So please dial in, or etc. So there is a recording, and I will post, send you the recording link. So don't worry, and I'll post on my YouTube channel. So just bear with me. So maybe you just see the charts or something. I don't know. So look at this Aurora Canopy. So 3-4 days of pullback after the move up. So it looks like it got stalled at this level. Yeah, you can dial in via phone, please. So you see the pullback 3-4 days after this big move. So, and then another thing. So when I'm not sure, but I believe when I spotted this ACB stock moving up like this, maybe there were other cannabis stock were moving. Maybe there was some news. So there was some logic at that time, the news, etc. So went in long around 13, 14, something like that, long. And worst come worst, I know the support is in this zone. You see the 14 zone, 11 zone. This is the support right here based on this resistance. This became support because the resistance turned into support. So we went long. I sent the alert to buy, and the target was around 18, 19. So we provide green, yellow, and red targets. So there are three targets, and I'll explain what those three targets mean. So just assume I'm sending you this trade alert and sending you three targets. So now look at it. This is the way the trade went, and then boom, you see how did I do any magic? This is what happened next day. So now 2 days. So the target was around 1870, something like that. So when I see this kind of the candle, when I see this kind of candle, you can dial in. Please dial in. So when you see this kind of candle, it's a gap up, big up move. So if I hold it, if I don't take my profit, I may give back the profit. If I don't take this up move, because what happened? So ask yourself this question: when you're trading options, and you see the immediate move in your favor, and within 2 days you see this immediate move, you need to lock your gain. So we locked the gain and 67% gain. Next one. So Airbnb. So now you see Airbnb. So I don't trade most of the IPO because I don't have a history. So it's very difficult to trade IPOs because they don't have a history. So the history is this. So you see, there's not much history. So what history I have is from December, mid-December to March, so only 2-3 months. Ideally, we need 2 years of history to read the chart properly. So here we have a few months of chart, but knowing the fundamentals of Airbnb, knowing okay, it moves big and it's bouncing from the 50-day moving average. So we took chances at 83, 183, 84. So you see, it dipped below the 50-day and then bounced back up, dipped below, bounced back up, and it's staying at 50 days. So it's like, I know it's high. We can say, okay, Airbnb can drop, maybe it can go to 80. Who knows? You know, I see 80 number here, 90 number. So this is just a scale. So who knows what will happen? But based on this bounce from 160 and above 50-day moving average and sitting at the moving average, please dial in the number. It's maybe in the link when you register. So 184 is the support. So we went long on Airbnb, and it's one of the favorite stocks. Like we making money in the stock whenever we trade. So one thing we need to know: if you are tracking your performance on a certain stock in your trade, that gives you confidence also that you can read that stock correctly. So Airbnb here at 184, and boom, it went to 207. So why we closed? So we closed because again, look at it, 2 days of big move and hitting some resistance. I don't know what happened to Airbnb after that, after we exited. Yeah, it's 12 months. Okay, so this is a recent trade. So we trade frequently. I forgot to notice. So we closed half of the position here, yes, on Friday, 206, 27. The target given was 210. So half of the Airbnb is closed because the Airbnb is wild. So it can come back right here. So it's better. I think we made $400-500 per contract. So half of the position is closed. 210 and above as the next target. So I'll explain what's the next target and what it means. So here's Airbnb. Simple, common sense logic bound on a 50-day moving average. Here's another one, Boeing. So Boeing, we were long, and we exited on this big move up. So we exited on our big move up. So the target for Boeing was 250. Target for 250. And why? 250 was the target at this time. Now the target is 310. So it's a revised 310. So this is where the Boeing crashed, right? We can see clearly that this is at 240, 250. This is where the Boeing, after gapping up. Imagine Boeing in November. So this is November. This is where they're buying it, right? They're buying it at 140, 50, and it just moved up, 245, and then it crashed, and came to 190 level. So now, so we went long somewhere here and exited. And okay, so this arrow, blue arrow. So we went long here, 25th of February, because I made the chart quickly, so I'm forgetting the dates. So 25th of February, here is the 25th of this February. So 25th of February, we went long on Boeing. Target 250. So now, you see, it pulled back for 2 days. So now when it's pulling back after this big move, pulling back, it's like a giant hand. You see, it looks like a giant hand. Still no sound. Okay, whatever, yeah. So please log into the audio via phone. So now, you see 2 days of pullback, giant hand holding 50 days, and then bounced up and hit the target. So hit 250. So one of the targets. 310 is the next target. It's going there. Here's another one, Bank of America. So now look at the Bank of America logic. It's simple. So the logic is simple. So it's sitting at the 50-day moving average. So you see, and here's the gap. So this is where it bounced back up. And here's the 50-day moving average. So when I look on the left side, and then I ask myself this question. Okay, I look at the left side and I see this is the support, and it's sitting there right there. Maybe in 28th of January, maybe 28th of January, the other banks were moving. I don't know. I forgot. So 28th of January, I look at the Bank of America and I say JPM, Goldman Sachs, etc. See you tomorrow morning. Still technical problem, no problem. Good night. No, the problem is solved. Please, John. I'm just talking through the phone. So you see here, look at the left side. Look at the left side. So the logic says that if it bounces from 29.30, chances are high it will go back up rather than go down. So here you see how it just took off like Boeing. You know, Bank of America become like a 747. So what happened? It dipped below a little bit, below 50-day moving average, but it did not crash. So what the traders do, they just immediately give back. They give in fast. They don't give the time for the trade. So took off, hit the previous resistance. So here's the target. If we want to know where we will exit, if we are entering here, we will exit here. We know already. So it's easy to know the target based on the previous turning points. It's easy because we can see. It's hard to calculate the target, understand the target when the market is trading in an uncharted territory. So here it is, right? So we exited 93% gain. So the logic was simple. Bounce from 50-day moving average on the left side, right here. Now here's, this is the first time I saw this. This is stock BNGO. So probably I saw the consolidation. Maybe there was a news I read and I said, okay, I need to go long on this. Maybe there was an option activity. There was a volume probably there. So volume in the option. So we went long at 11.65. So there are many reasons to go long. You never know what went at this time at $11.65 BNGO trade. So you see here, and then boom, 15.57 we exited. So this move was over for us. I don't know where it went. 67. Then when we get a 67% gain in the option, it's good enough. Here's another trade, CRM. So CRM is another one we trade regularly. So CRM is holding 200-day moving average. So if it's holding 200-day moving average, what are the odds of CRM to go down below 200-day, then to go up? And here's the gap. So here's the gap to be filled at 240 levels. So, and I look at this and I say, okay, why is gapping up from the 200-day moving average? So there has to be some reason to gap up from 200-day moving average. So the logic is simple. Gap up from 200-day moving average, go long, exit somewhere near 240 when the gap gets filled. Let's see, where did we exit? So we exited right there. You see, 240, gap fill, gap here. So they call it window open, window close. So this window got open, this window got closed. So window open, window close. So simple logic. Bounce from 200-day moving average, exit, then this gap is closed right here. So 109% gain. Here's another one, Cron. So this is another one. So after 3-4 days of pullback, the stock is making a move to the upside. So what are the chances the stock is making a move like this? The volume looks good. Maybe there was an option activity. I forgot. So the chances are high that it's going up further than going down below 10. And you see how? So the next day when it went up, it closed in option. When the stock moves from 10.50 to 12.50, 12.25, it's $2 move. $2 move for a $10 stock is like what? 20%, 18% move. So 80% move in one day gives you 92% gain in the options. So the logic is simple. Here's another one, GPS. So GPS, the gap is bouncing from the consolidation. You see, it looks good to me. This candle is telling me that they are buying it after this all the ping pong fashion. You see the ping pong move all up down up down up down, and then suddenly there's something going on. Maybe there was a volume in the option. I don't know. Maybe. So I check the volume and I say, okay, looks good. It's bouncing and it's holding support. Maybe it will go here near 26 level, fill the gap somewhere here. So I'll get out. So I get in at 2050, something like that. And what happened? So it took time for GPS. It took time for GPS, and we close it here. So when the stock is, let's say if the stock is, we bought the option, and it's losing in time value. And let's say we open a March calls. So and we did not exit here. Let's say we didn't exit here. So that was a mistake. Maybe the target was here. So if we are holding, or if I'm holding it and I have a March call, and then I see another move coming, I may not buy the same strike or same month because the time is running out, or the time we kick in, but I will go and add another one, another strike, another month, maybe April, and I add it and close the trade as a basket. So I may be getting out at break even in the March calls, or maybe losing some and making money in the April call. So that was the logic. So you see, entered here. If we missed this exit here and then it went on a sideways, then it tanked here, but it did not break this level. It did not break this level. It just stayed and then moved up. So 69% gain. Here's another one, Hexo. So big volume. So this is the kind I don't trade often, because the signals came here somewhere and I'm buying here, but the volume is huge. Maybe I saw the volume in the option, so it's trading higher. So got in here, and yeah, so it went from 6. So we entered around 6. It took a while. So if you count the days, it took a while for Hexo trade to work. We missed this exit here. Then it went sideways. So you see, 2 days of up move, I should have exited here. I violated my own rule. Maybe I revised my target. So went down and eventually exited around 950. So entry at 6, exiting at 950 is 50% move in the stock, 50% move because of the time, etc. The gain is 121%. Here's another one, FDX. So we trade FDX and UPS. So if FDX is moving, look at UPS. If UPS is moving, look at FDX. They are moving. Most of the time they are moving together. Sometimes it's just one of them is moving, and it could be that we are not in that one. We are in another one which is moving, but this one, FDX. So you see here, if you look at this, what are the chances FDX to come down and start going down? So for me, the chances are that FDX wants to move higher. It moved here, move higher. I'll take my chances. And it took a while, so got stuck in the trade. So sideways motion. Maybe there was no volume, sideways motion, but eventually got out 62. So only made like 18.75% gain. So managed to got out with some gain. Here is Intel. So we trade Intel, and here's the move. So if you look at this chart of Intel, I mean, do you need any other indicator to tell you that Intel is not going up? I mean, any indicator, any newsletter, maybe Trade Genie newsletter to tell you. Ken here leaving disappointed. Oh man, disappointed. Sorry. Okay. So 56. So nobody should tell you that Intel is not a buy. So if 200-day moving average is right there at 53, right? So got in at Intel. So now where I will exit. So so when we are entering trade, we need to know that previous turning point. So create the internal map, create the path where the stock will go. So the path is this. it will come to 60. Maybe it will stop here. Here on the left side, here is the resistance, big resistance here, but it broke it before. So let's see what happens. Just a second here. So you see, it went double top, double top. So we exited at the double. We don't know. It came down. It can do the same thing again. So, but entered here. When we entered during the day, you see here, the candle looks like this. The candle is looking like this, very beautiful. But then later, at the end of the day, it pulled back. So it's okay. But then it went up, double top, exited again. So 50% gain is not bad. So let me go back to this slide. So I'll show you more charts. So we do have a swing option services on the website. So I have a pre-selected basket of stocks. So I do the work before. So create the basket is very important. Traders, they just go for 8,400 stocks. So they shouldn't be doing that. They're looking for the universe and then trying to find the stock instead of creating a subset of the universe and then applying and then looking for what they're looking for, on those subset of stock. So we in the swing option we have 8 to 10 trades per week, maybe more. Objective is 40 to 100%. I provide the buy price, exact buy price. So I'll show you how we send the messages. The 3 targets, so green, yellow, and red. I call it green, yellow, and red. They're expected to. The trade is expected to last 7 days. Sometimes it goes to 13 days because of sometimes we get it stuck, or sometimes we see the more potential. We send alert via email and SMS. So if you provide us the phone number in your phone carrier, you get the instant message. We constantly guide you. So there is a 71-page guidebook also give you education via webinar, like I'm showing you right now, and I'll hold more webinars every 2 weeks. So for this service, you need 15,000 in the portfolio, and you need to be active, like can act among the trade, through your phone or your laptop or your computer, depends what you're doing. Okay, so I show you another trade, IQ. So here's another one. So IQ is Chinese stock. So maybe the Chinese stocks are going up. So and then look at this one. So somebody has to tell you that don't go long or go long on IQ. If you look at this chart, you say, okay, it's moving up after consolidation, 2-3 days. It has been moving from 17, and it consolidated here for 2-3 days. I'm going in. The volume looks good. So here's the gap at 22. It will get filled. Then another gap at 27. Maybe it will go here 27. Who knows? But I'm getting in around 20, 1950, something like that. And you see what happened? It went up to 23. So exited, 74% gain. Here's another one, JD. So when Alibaba moving, Amazon moving, maybe JD is also moving. So look at all those. Maybe there's a news from China. So it went on a sideway and then moving. Maybe there was an option volume. Maybe there was Alibaba also moving. Maybe Amazon moving. So JD is called Amazon of China. $97 entry. So entry at 95, 97, and then boom, it gapped up. So as soon as it gapped up to 103, so I'd rather take profit and worry about it later. So 47% gain and on the 4th day is pretty good after the consolidation. So this is the resistance. This was the resistance, and it broke from the resistance. So we exited. Maybe it came down and filled the gap, and then re-entry from 100 to the upside. But for option, this 47 is good enough. Here's KSS. So there was a news when we spotted this move. I did not know there's a news there. I think there was a management news or something was there, and it was after hours they were talking about it on CNBC. So after this consolidated move and the market is moving like this, so what is the reason? So I don't know the reason. Act first, shoot first, ask question later. But I know that something is happening here after the consolidation. Something is happening. This is a large move. So got in, and you see the next day it gapped up, and it went up higher further. It went up, I think, more. But because the entry is here, and the next day you see the gap, and this is the bar you're seeing it, so I exited 64%, and then there was a news, and it went up, I think, further. So if you enter here on this bar, you catch it, you exit here in a high volume. So when the market is gapping up and there is a big volume, chances are that the next day it will come back because no buyers left and it will pull back. So I exited at 64% gain. Here's another one, Momo. So please, audio, please dial in. So Momo, here's the Momo. So if you look at this chart, Momo, 3 days of pullback, and then Momo is going up. So what are the chances after 3 days of pullback, Momo will come down? If it comes down, okay, I will lose money. Maybe 15 years the support zone. So this is the all support zone. So here's my risk. So I check chances. If I go long here, and if it comes back down here, I will wait for it to recover at around 15, 14. I'll wait for it to recover, and then maybe average down, maybe buy more. So people say it's never average a losing trade. So that word never is not correct. You can average, provided you know that you are doing it correctly. So here's the zone, support zone. So enter long in Momo, and you see the third day. So when the first day we missed the move. We did not exit, and it pulled back like this. So created a negative, like not a good bar, not a good candle. So the third day when it went up and making hitting the same resistance, so we got out at 32% gain. The gap is not completely filled. The gap is at 20. It did not get filled. So exited Momo at 32. MRO. So when we bought MRO, maybe oil stocks were moving. So I watched crude chart. So look at the crude and see other stocks are moving in oil category. So MRO looked good around 950, 975. Volume is good. I don't trade. Most of the time I'm not trading the chart like this because it's overextended. But after 2 days, a pullback is moving up. Maybe other oil stocks were moving. So got in and then exited at 12, around 12. So you see 103% gain. So this was the entry. There's no indicator. On my chart, there are no indicators. So you see here, I used to have RSI, stock exchange, MACD. Look at this MACD histogram. It's curling up to go long. Maybe, I don't know. I don't use it. I used to use MACD, RSI when I was learning, but I don't anymore. So here's the entry, here's the exit. Here's MVIS, so Microvision. So I read the news that Tesla may be interested in buying it because of the technology. So it was gapping up from consolidation. So I said, okay, we can go long. The news is there that Tesla may be interested. So the chances are pretty good that it's about to break the resistance. So it's like a cannonball. So it's approaching the resistance with a cannonball, not like a tennis ball. So imagine a line like a wall. If the wall is getting hit by a cannonball, chances are the cannonball will break the wall. If that wall is being hit by a tennis ball, so chances are the wall will not be broken. So it's like a cannonball getting fired towards the resistance line here. So I take my chances. And you see how the cannonball broke the ball broke the wall. So cannonball broke the wall. So here is entry, and once it so this is the entry right here, and then boom here. So 134% gain was good enough. I wanted to hold for a longer period, but then I said, okay, I'm being greedy. So greedy in option means that it can pull back to 3 days, and this 134 can become a 10% gain. So better to exit. Here is QS. So look at this quantum escape. So this moves big. So it crashed from here 120 all the way here in the consolidation. So when it's consolidating here, sideways move, and then boom, suddenly there's a gap. So when the market gaps up from consolidation, so there must be a reason why it's gapping up. There has to be some reason, and the volume is looking pretty good. So I would take my chance on going long, right? So should one buy? So I'll explain. So what I would go long in this trade, take my chances, than to ignore it, right? Then what happened? Okay. So look at this one. So sometimes we get stuck, but conviction is there that we will come out alive from the trade. So this trade, we were stuck for these many days. So you see, but if you look back on the left side, so we say, okay, look, and let's look on the left side. So this is where is the support, and it moved to 120, 130. So suffered this drawdown. So it's not like all the trades. I say, okay, I'm a magician. I send the trade, and then next 2 days, it just go and hit the target, and we are all rich. So this is can happen. It's continuously, little by little, is like going down, 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 slow, slow, slow. But it came here 40, and then boom, up, sold it right at this resistance, sold at this resistance, and we trade often. So we traded again, and then another thing, when the market is moving up from consolidation, so we can add more to it. So we provide alert that you can add more to your position. So adding more and then exiting here at the previous resistance. So luckily we made 80%. Here's a Starbucks. So Starbucks, if I see this move and after this dip, and I'm looking on the left side, so this is where the consolidation took place, and then it went up to 107. So the chances are maybe the Starbucks has found this support. If I look on the left side, I see this 95, 94 support. So we went long on Starbucks, and you see, went long on Starbucks right here, gapped up, closed it. So when the market goes towards the resistance, hitting the resistance, I don't know what will happen. This is a big bar. So this is a bearish bar, this red bar. The sellers are sitting here. Maybe they will appear again and sell at 107 and 8. And I have fourth day of the trade and 80%. So I need to lock my gain. Here's another one, SPY. So we trade index options. So SPY, DIA, QQQ, TQQ, SQQQ. So SPY pull back towards the 50-day moving average. So it can go through the 50-day moving average is possible. And then if it goes here and hugs the 50-day moving average, I can add a little bit more. So I initiate my trade on a gap down towards the 50-day moving average, bought the call. And then you see bounce back up. So the market can pull back. It pulled back for 2 days and set at the 50-day moving average, and then it bounced back up. So close the call at 35% gain. Now this one is magical. So SQQ, it runs against the NASDAQ. So if NASDAQ is going down, then this one is going up. So this one, SQQQ, is just crashing from 47 level all the way to $12. So there's no indicator here. So there's no indication that this will go up, right? So where I put the blue arrow, so send the alert to go long and SQQ calls. So why chose SQQ? So maybe look at the NASDAQ chart. Maybe the QQQ gap down. So look at that on this day, 16th of February. So look on this day, 16th of February. So on 16th of February, look at what happened in QQQ. Maybe the QQQ gap down. So QQQ gap down. NASDAQ was about to go down. So if QQQ gap down, instead of buying puts on QQQ, we bought the calls. I sent the alert to buy calls around here 12. So there's no indicator right there, right? You see, there's no indicator. Nobody can tell SQQ is going up. But you see, It went to 14. We made 14. It actually went up further, but I closed it because I saw there's a reversal coming up in Nasdaq. So we closed this call, and then next day the Nasdaq went up. So the gains in SQQ must have gone down, and then Nasdaq again went lower. Maybe the gain stayed same. So we closed at this gain around 14. When SQQ hit 14, but the exit in SQQ was not based on any technicals on SQQ. It was based on the Nasdaq cash index. Maybe it was based on QQQ. Maybe it was based on Nasdaq futures. Maybe there was a news. So maybe Apple was moving. Maybe Baba, Google, Amazon, they were moving. And it seems like the market going up. So now it's time to close SQQ. So close SQQ trade. I will answer your questions later. So SRNE. So this is Sorrento Therapeutics. So again, same formula. So it's like same formula applying on a different stock. So same formula applying on different stock, but have a basket of stock. So SRNE, after 3-4 days of pullback, it's making a move. So if it's making a move, chances are that it will continue move again next day, tomorrow. It has just started. Maybe I get lucky and 2-3 days, I'll make some money. But made a lot of money. You know what happened here. Okay, so this one, the symbol is wrong. FDX. It's not FDX. It's SRNE. So you see how lucky we get. So we entered here, $9.62 after 3-4 days of consolidation, and then it went up like this. So I'm not counting my blessings here. You see how I'm getting greedy? I should have gotten out here. Then very next day, it made a big bar. And if I look on the left side, so if I look on the left side, this is where the sellers are, right? So this is where the sellers are. I should have gotten out next day, but overlooked, maybe doing something else, got busy, and then saw this move and finally exited here. But the gain was 212. So if you're entering at $9.50 and exiting at 14.15 in the stocks, and then I buy shares also. So it's not only the option. So I'm buying shares also. So we have a tiny stock service at $87. So you can sign up if you trade the tiny. I call it tiny because these are like tiny, $9, $10, $2. So $9.50 going to 15. So it's pretty good profit in the shares and also in the option. So I may close my option position, but I may hold my stock position, or I close my options and hold some shares and close some shares. So it depends, right? But it did that. Here's TCOM. So TCOM, I think we got trapped for a while. So we entered it on 3rd of December. So you see the date, 3rd of December. So we entered at 34. So we entered here based on this move, lot of red days, no white day. And then suddenly we saw this. So it's the same formula. So applied the same formula and got stuck. So here is what happened in the TCOM. It got stuck. It just did this. But if you look at the move, so if we are entering at 34 and it's doing all this and going all the way to 31, so it's only $3 move. So it's not much. But because of the time decay, so it's all like, it took 1.5 months. So it took 1.5 months, but maybe average here more a little bit, maybe add more when we see the conviction. So exited at 51, but it took a while. This trade was open for 1.5 months, but there was no exit, and had a conviction that it's not that bad. We need to hold. So 51% gain. Here's TRXC. So this was a new stock I found. So this is a daily chart. So I just don't use daily chart. It's a daily chart. I'm showing you the example of daily chart because the pattern I'm detecting is on daily. So I'm showing you the daily. But then I have to lean. So I'm just answering one. So I'm leaning. I'm leaning on weekly and other intervals. So I'll explain maybe the time intervals later in another webinar. So there are multiple time frames I use. But I'm showing you this daily chart. Because the pattern is getting detected on a daily chart. So I'm showing you that, but I'm not just using daily chart. So TRXE here at $3. So bought the shares. It's called tiny shares. So bought some shares and went long on options and moved 4 or 5 days of up move and then one pulled back. And the next day we just exited at 175% gain. So 175% gain in option, but 100% gain in stock. So you see from $3.50 to almost like $7 here, right here. So 100% gain. So maybe close the option position and hold the shares. So it depends. Here is Uber. So when Uber is going up after this big reversal, so why is going up? Suddenly it closed here at 47.50. It opened on the red day. It opened at 50. So if a stock open at 50 and close at 47.50, and next day it gapped up at the previous day open. So you see there's a big jump. So if there's a big jump, open at 50, close at 47, and then jump up, open again at 50, that is a super bullish sign that this market wants to go higher. So there's no indicator needed to say, okay, indicator, tell me if I go long. So you just go long because that makes sense. Something called street smart. So street smartness. When long, look at that. So the signal came here at 50 and it went to what? $60 previous resistance. So 91% gain. Oh, you see, I did a good job, 90.99%, not 91%, 90.99. So here you see 60. So what is the logic? The logic is simple. Um, it opened on the red day. It opened at 50, gap down 50. So you see, gap down 50, close at 47 something, 47.50. Next day open at 50, fill the gap, go long because worst come worst, it can come down to 47. Maybe I'm out, but if not, then it will do this. So based on the experience, this simple logic, went long, 91% gain. Uber, maybe Lyft was moving at that time. Maybe there was a news, economy opening, people are taking rides and all that. So whatever it is, there's something there. Visa. So when I'm looking at Visa, I'm looking at MasterCard also, Square, PayPal, etc. So just to see what the others are doing. If PayPal moving, Visa moving, MasterCard moving, Square moving. So maybe I choose. So I choose which one. So chose the Visa, and the reason could be this. Visa hang from 220 all the way to 195 below, right? The 200-day moving average. But then it gapped up above 200-day moving average. So I have to ask why it moved up above 200 moving average. So I'll take my chances on this one. I can buy here, stop is here. So enter at 198, and you see what happened. So it came down, hold the level, and then boom, went up. So when it went up to this level, this is a swing reversal point. This is where it tried to move up but then crashed. So I know this is a big seller area. This is a big resistance. All this is a resistance. So I better take my profit because I saw this also. So you see, I saw this 44% gain. Now here's Zynga. So Zynga, I think I saw that based on some option, and there was some Reddit, something going on in Reddit. So went long at 1037, option volume very high. This resistance support. So I take my chances. I say, okay, we go long here at 1037, and you see It broke it below 1037, came to 975, not that bad. From 1037, 1035 to 975, and then it bounced. So there was a heavy option activity on this day, heavy option activity on this day. The result came here. So when it gapped up to the resistance, exit 52% gain. Heavy option activity doesn't mean the stock will always go up. So you have to, you know, do some technical analysis on the chart. So gapped up to the resistance, got out, 52% gain. Here is X. So X is a killer trade for us. Made a lot of money. One of the member in Philippines, he's in Philippines. I mean, imagine in Philippines, he's trading X. He sent me his screenshot. 24,000 gains in X. So look at this one. So steel. Now, what's the logic? You see here, after hitting 24, 25, it went here to 16, and it's consolidated. So this is a support. If I look back on this left side, I see that it moved from 16. So I missed this move. This move I missed. So my entry was on 24th. So missed this move, and also I think I sent the alert. So we had the trade March call here somewhere, and I sent the alert to buy here also at 16. April call. So we simultaneously we had March and April. So this is what happened when you have let's say we have a March call and it's not working out and about to lose money, but the trade is working. So instead of buying, adding in the March call because it's so close to expiry, but we believe in the trade. So if you believe in the trade, then you don't have to add this down on the same trade. You just buy some extra time and close the trade, which is like about to expire at break even, maybe lose a little bit, maybe lose a lot, but we're making up in the April call. So we did good in March and we did super good in April call. We sold majority of it at this target. So on Friday, we sold on Friday along with Airbnb, half is here. So this is the reason. It can go above, but who knows? It can come down. So logic says that when the market is going to the previous resistance, we need to sell. So we sold. What happened here? So I think we sold. This is a March call. So we sold here March call, but April call we sold here on Friday. So this date of 10 March is not showing the April call. So it's showing for the March 1828. So there's the April call. Sold probably half. Yeah, that's what my instruction. So it's not 100% close. So that's why I've not prepared the chart. So April call made a lot of money yesterday, Friday. Here is Exxon. So now, so crude stocks. I watch the crude chart. So just don't watch the particular chart. So because it's related to crude, so look at the crude chart and see if crude is moving. So Exxon usually, so this is a bullish pattern. So when the market gaps down and makes this kind of pattern, candle, doji, gap down, and then next day it gaps up and do this, it's a reversal signal. So it's a reversal signal to go long. And maybe I look at that time I look on the first March. Maybe I look at the crude stocks like CVX and others, MRO, etc. Valero, they're moving up. So I chose Exxon and went long at around 56. And you see, it went to 62. So we closed at 62, 69% gain based on this detection that this is bullish, gap down and gap up. So simple detection, there's no indicator needed, just like common sense. So once again, the swing option service we have on the website, you can join, and I will explain I'll show you another presentation. Just a second. So I'm opening another presentation, so you will briefly see no screen. I'm trying to explain you the targets. So Just a second. Okay, so I'll explain the messages we send out to just to make you better follower Trade Genie. So explain you the different messages how we send. So when we spot the trade, send you the simple message, just one line. There's nothing, no more than a subject line. So I put the trade instruction in the subject line. So there's no story, copy paste somewhere, story, long story. I don't do that. Just sometimes I do write a little one liner, like what's the reason. Sometimes I don't give the reason right away. Got no time to write the reason. Just give you the instruction to open the trade. So what I'm buying. So it and then SMS. So SMS is instant. So you receive the instruction right away within the second. The max is within 5 seconds. So here, if you see this subject line, so it says SB. So stock is SB. Month is March. The strike is 245. So we are buying calls instead of either calls or puts. So calls is there. So February, March 25 strike calls, and then buying to open. So we are opening at $10. So it's specific price at $10. So this is explanation. Only instruction you receive in the email or SMS is this. February, March 245 call, buying to open at 10. So it's not like this trade is trading at 11 or 10.50. It is trading at 10. So that's the price. It's trading at 10. And then I watch the orders getting filled. So if something else is happening, I immediately inform. So within a second, you will receive another update that you can buy 10.20, 10.40, 10.30, something like that. So this is the first instruction you receive in your email. Facebook, March 245 call, buying to open at 10. So this is the first message. Then the second message could be later on, not the same day. So this is an additional. So let's say the Facebook pullback. I'm watching it, and instead of 10 now, it's trading at 6. So it's trading at 6 and it's open. So I would send out another message saying that if like you can buy more at 6 because it's right at the support. So not all the trades go straight and hit the target. So let's say if Facebook option is trading at 6. So when I send this message, buying more at 6, it's at support level. So Facebook is at support level. I don't buy willy-nilly. Like I receive messages. Should I add more right now? So the stock is going down. I don't see any uptick. So I don't see any support. So it's not a good idea to average down because it's trading at 6. Maybe it will go to 4. So don't just buy more just because to feel good, to bring the average cost down. Sometimes we feel good in bringing the average cost down. So you get the feeling. Okay, look at this. I had a $10 cost. I bought more at 6. Now my average cost is at 8. And so feeling good. So we don't trade to feel good. The stock must be at if it's called, it must be at some support and showing the reversal. When it's showing the reversal, I send out the update. Say that if you, so I give a three structure. So I say, buy more if you already have this trade. If you can, please buy more. So allocate some more dollars. If you don't have the trade open, so let's say you are a new member. So let's say Facebook was open 3 days ago, and today you join. So you join, and you receive this message. So instruction says if you don't have a trade, if you're a new member, please enter. So you got lucky. So you're buying at 6. And then the third option is don't do anything. Just stand there. Or maybe buy stock. If you have a bigger capital, you can buy some shares of Facebook. So whatever is your theory at that time, out of those 3, whatever is your situation. So let's say we buy at 6. So this is the buying more exception. Now, when we send the first alert, buying to open at 10, immediately after, three targets are provided. So I name it in green, yellow, and red based on the signal, so traffic signal. So even my daughter knows what does this mean, green, yellow, and red. So I'm explaining to you, and then I'll explain the conditional order. So I provide three targets, and I call it green, yellow, and red. So I'll explain what the target means. So let's say Facebook. So February 245 strike, right? And Facebook is trading, let's say at 243. So the green target could be 240, 250. So green target 250. And let's say the yellow target, I say, okay, it's 254. And the red target, let's say 261. So that's the example. So I should have written down the example. So those are the three targets, green, yellow, and red. So now what to do at those three targets? So in the guidebook, I've explained, and I sent out the email message explaining the targets. So I'm explaining to you right now. I'll explain in the next slide. So ideally, you can. So people ask me, okay, I understand these green, yellow, and red targets. So these are stop price targets, not the option targets. So we bought, let's say we bought Facebook at 10, and if you like, you can set at 40% profit. So if you're buying at 10, your 40% target is $14 on option. But I don't do that. That's a default. So let's say default. If you didn't receive the green, yellow, and red target, you set your target at 40%, so it's $14. But once you receive green, yellow, and red target, then you can set the conditional order. So I'm now, in like 8 years ago, 10 years ago, people didn't understand. Now I think everybody understands, but I just explained to you what is conditional order. On a trade station, it's called activation rule, meaning sell my option contract based on certain conditions. So the condition could be the stock hitting this target. When the stock hits this target, sell my open option contract, whatever was the last price. So if the liquidity is good, you will get hit by the proper bid and your order will be closed. So that is called conditional order. So sell option based on stock target. So you can, if you have three contracts, let's say you bought three contracts. So, and green target is 254, yellow is, let's say, 258, red is 261. So you can set the target, one option contract sell at this target, another one this, another one this. So when the stock is hitting the target, your order is getting executed at the last price, whatever was the last price. So that is conditional order. So now, sometimes we also, so I'll explain what is green, yellow, and red mean. So sometimes we do revise the target. Most of the time is to the upside, sometimes to the downside. Also, depending on the market conditions and what the stock is doing, or it's stuck. Sometimes the stock is stuck, so we downgrade the target. So target. So when we revise the target. So the logic is, to make it simple, the green target is the first target, and then yellow is the second, and the red is the third. So when the target is being revised, whatever was the red target becomes the yellow target. So it's like upgrading it. And then the yellow target becomes the green. So we have a higher green, and then we have a higher yellow. And then I provide you a new red target, which is above the previous red target. So you have more potential in the trade. So new red target is given. The red target becomes yellow, and the yellow becomes green. So you have a higher level of target. So I have members who trade only one contract, so they can sell at yellow. But I have members who have $1 million of portfolio, so they are selling some at green, some at yellow, some at red, and then they are waiting for my instruction that do I have a revised red target? And I know I'm watching myself, and then they are sending me email also that do you have a revised red target? And I say yes, hold it. So a few minutes later, I'm sending the revised red target, and they are holding it. So it depends on your portfolio size and what you're doing. So the target can also be adjusted to the downside when the trade gets stuck or the overall market condition not looking good, or we have a lot of open positions. So we say, okay, we need to revise the target. And another reason could be that that stock got stuck in some kind of a resistance. So when the stock is getting stuck in a resistance, the targets are getting lowered because we just want to get out, lower the target. It's like downgrade and upgrade situation by the analyst. So target revised. So I send out an alert saying targets are revised, and then you can see the revised target. Now trade updates. So let's say I send out the instruction to buy, and then the targets are there. So we bought this. You have the target, so everything is okay. Stop is there. So stops are sent to you based on the technical analysis. So I don't send out the stop based on the percentage of the option. So if you buy 10, set the stop at 5. So it doesn't make sense because we are trading stocks. So if you are applying technical analysis on a stock and then choosing to trade options, it doesn't make sense to just willy-nilly put the stop based on the option price. Okay, we buy a 10 and let's say $10, $5. So I do provide the stop based on the stock price. So during the day, if there is an update, so I provide with the update. So any news update, any technical analysis update, anything worth your time to read that update. Sometimes there could be multiple emails because I want you to read that and understand. So if you're yourself good at it in trading and you're getting some feedback, and then you are also applying your own thing on your chart, then you have a double confirmation. So maybe you're exiting it properly or you scaling in. So the money is made by scaling in and then scaling out. So having a multiple exit strategy, adding more when you can, and I'm providing you the update. So there's updates being provided. Sometimes I send out the update just before taking the profit. So when the target's about to hit, I send out the update to get ready. So you know that. So now comes the exit. So exit needs to be managed properly. So the traders, members who have a different kind of portfolio. So someone can have a $5,000, $10,000, $15,000 portfolio, and someone can have a $6 million portfolio. So I don't know. Some members I know, some I don't. But usually they like 50,000, 70,000, 100,000, something like that. So there are various kind of sell alerts I provide. So let's say the market hit the yellow target. So when it hits the yellow target, so it's the middle. So I may send you the alert to sell half of your position, so selling half. So if you have 10 contracts, you sold half at the yellow target, and I'll explain what the yellow, green, and red mean. So you have better understanding why we are selling half and majority. Sometimes we send alert to sell majority. So if you have like, let's say 10 contracts, so majority for you is 7 or 8. So you sold 7 or 8 at the red target or yellow target. So if you sold half or you sold majority, then the logical sense is that the next alert you receive is sell rest, right? So you sold half or sold majority, so sell rest. So sell rest is the kind where you don't mind seeing the pullback. You have already taken your money out and you're looking for a higher target and you don't mind holding it. So sell rest, that's where it triggers. Or the first alert you get is not the sell half, not the sell majority, not the sell rest, like all, sell all. So I send the alert sell all or sell to close, selling to close. So you're selling to close or sell all. So something like that. Sometimes the alert you can receive is the price range. So let's say the target yellow is 160 and the red is 162. So yellow is 160, red is 162. So the target is in between. So I can provide you the range. So I say, okay, please sell between 160 and 162. So or 161 and 162. So let's say the yellow is 160 and red is 162, and the stock is trading at 161. So I send you the alert saying, okay, sell all in this range, 161 to 162. So I'm going granular. So I'm providing you a tight range. So now if you are a busy person, you're not watching the chart, so you're not waiting for 162. So you see 161, you close it. But if you are a full-time trader, you're watching your own chart and a 5-minute chart or 3-minute chart, and the stock is moving up, then you will say, okay, he told me to sell between 161 and 162. It's trading at 161.10. Let's see if it pushes towards 162, and I'll close it. So you take advantage of that and you close it. Sometimes we send out the alert to sell to close by market. So the scenario is this. Let's say it's Friday and it's 12 o'clock and the target is 162 and it's trading at 161.50. So I can say, okay, sell to close by market. So it means before the market close, you have the option to close it now, or you can wait, watch, and close it next hour or 2 hours by the time the market is closed. So sell to close by market because it's trading within the range where we are supposed to close. So I give you, or sometimes the stock is just moving up. So it's moving rapidly towards the target, let's say towards the red. So I give some more, like some margin for you to close, take more money, like 20, 30 cents per contract extra. So that's another kind of a sell target I provide. Now there's another one, ultimate target. Like it doesn't get issued often, but it did last time when the Nasdaq hit 10,000. So close when index hits a target. So if a major index is hitting certain target, which is a like granddaddy target, and we have open position. So I can say like this to you: sell all your long positions when the Nasdaq hit 10,000. So it happened when 10,000 hit, we closed majority of our position. So you can do that. You can set the conditional order based on this. Close when index hits the target. So you have a conditional order. Close all my position when Nasdaq hit 10,000. So all your closed position will be closed when the Nasdaq hits. So this is another kind, but I don't send often. So these are the variety of sell orders sent out, and all of these. So I make sure. So if you have SMS with me, I make sure you get SMS, the buy instructions and the sell instructions. Those two are important. So you're getting it, all those in SMS and other also, but those two are for sure. So now I explain to you the green target. So I'm explaining you the green target. So the green target is the immediate target we provide. So it's the immediate target. The expectation is very high that it will hit, the stock will hit this target. It's like 95% probability stock will hit the green target. So if you don't mind closing at 20%, 25% profit, you can do that. So based on the green target. So green target is 95% probability. So that's the first target. Okay. You could be selling some because you may be overexposed, so you have a bigger position, so you may sell quarter of a position green target. It so happened that instead of buying 10 contracts, you ended up buying 15. So you were not supposed to, but you did. So now you're overexposed. So you say, okay, I need to lighten up on this one. So maybe you're selling your 5 contracts at the green target, so you come back to your desired exposure in that position. So that's the green target. So it's the target which is expected to hit high probability, like 95. The second target is the yellow target. So it's just like traffic light. So you see, when you see green, okay, green, it looks good. It will, you just keep going. The yellow, okay, be cautionary. So it acts like that, yellow target. So so if you say, okay, what's the probability? So 85% probability stock will hit the yellow. And if the market crosses the green with the volume, then it's expected to move towards the yellow. So majority of your options should be closed at yellow target, unless I send the revised target of yellow. So then you can hold. Otherwise, you're selling majority at the yellow target. So expectation is to sell half or majority of it. And also watch the market conditions. So when your yellow target is hitting, you're watching the market conditions also. There's a lot of things going on in the market during the market. You're not just watching your own one position or two positions. You have to look at a lot of things, and then decide. So if the market is pulling back and your stock is trading at yellow target, maybe you sell all, maybe you sell half. So do something. So a lot of variables uh, in decision. So I do send out majority of time. I'll send out unless I'm outside somewhere and I don't see it, something happen. But I'm sending you the alert to that the yellow target is hitting. Now the red target. So the red target is the ultimate target. It's like you, so the probability is lower, like 70%. And after the red target is hit, the chances are that the market may pull back towards the yellow or even go towards the green target. So the red target is the where you can make a lot of money when it's hitting it because it's little further away from yellow. And then when the red is hitting, I send the alert to sell rest. So it means we sold half or sold majority of it before at yellow, etc. And now we are closing the position. Sometimes when the market is going through the red, it's like going through the traffic light, and you got lucky. You didn't hit anyone, and you are on the other side of the traffic signal. And then there is nobody because you were the you were the maybe the first one, or there's road clear. So when that happens, when the cannonball is fired and the resistance is broken, then I revise the target. So I send out the alert saying, okay, the red target is revised. So if you have some, maybe, and you receive the alert saying, okay, red target is revised to the upside. So you have more potential. So I give you example of Airbnb. So the target was 200 red, and then when I saw the potential, I raised it to 210. So now you have a 10-point profit potential. So you sold. So the red was 200, it became yellow. So the 200 becomes the yellow target, and the yellow was lower than 200. And now we have a new target, red, 210. So Airbnb has expensive options, so it's like $16. So if you have like three contracts you have already sold at 204, 205, now you're waiting for one more contract to hit at red target. And maybe the red target is further revised upward, so maybe going to 225. So you're just riding it and holding for more and more revised red target. So red target can be revised upward for call. And if we have a put, then the red target is getting revised to the downside because the market is tanking. So you will keep seeing the revised red target, but it's to the downside. So that's the logic of green, yellow, and red target. So I'm explaining you the importance of red target. So there's an importance of red target. The stock hits some. So I calculate the red target based on some previous heavy resistance. So which I expect that the market may not cross it. So, but if I see it, I send you the alert. So stock hits major resistance for calls or for puts, it's a major support. So it's a major resistance or major support. And after hitting that major resistance or support, the pullback can be severe. So that's the reason or the importance of red. Pullback can occur towards green. So if the market hits the red target, it can come down to yellow and come down all the way to green. So you may be giving back all your profits. Pullback can occur towards entry price. It can come down back to the entry price. So that's why it's important that you sell majority of your contract at yellow unless I revise it, then you can hold. So because you see how the market goes to the resistance and then pull back. So it may go up, but the option you lose the value, you lose the profit. Now, very important to understand where the traders don't understand this, so I'm trying to explain you. The targets are like magical. So, but it doesn't mean the target will, just because you're trading options, you're just trading during the normal market hours. The market is actually open 24 hours. So, me and you, like there are 150 people, we can do the trading right now on a handshake. I can say, okay, sell me Apple, and you sell me, and I'm buying it. So the market is open 24 hours. We can make a deal at the Starbucks or wherever at the park. So if you have an option trade open, it's just that the option market is closed during market hours. So if the stock is hitting some kind of major target, during pre-market or after hours, that needs to be understood. So if it's a red target, so if some major target is hitting at the pre-market level or after hours, and that's the high. If we have a fall, that's the high, like AMD. So AMD after earning, it hit 9,900 after earning, and then it pulled back. So when I send the alert saying, so somebody asked me, and I said, AMD has hit the target. It's just it hit in a pre-market or after market. So he did not understand what I'm saying. So when that happens, when the market opens, so if the red target hits during pre-market hours, and when the market opens, chances are the market will open and continue going down. So then we wonder, okay, everything was fine. It was trading at this. Now, what happened? Why the market is going down? So it's like magic. So that's the importance of red target. Now, I do revise the red target when there's a gap occurs. So if we have a call trade and the market opens above the red target, gap up, so it means the cannonball was not only fired towards the wall, or like, just think about this like this. There is a fortress and there's an army outside and they are firing the cannonball. So they're firing the cannonball, but the cannonballs are not landing at the wall. So nothing is happening. It's just going and outside landing. And the army inside the fortress, they are secured. But then imagine this: the cannonball is fired, and it landed at the wall. So it damaged something in the wall. But the people on the other side of the fortress, they just fixed it right away. So in other words, if the market hits some resistance with the tennis ball or cannonball, it may not. It can cause some damage on the resistance level, but it doesn't mean that it will continue going up. It caused it scared the buyers. It scared some sellers, but then the sellers came and they drove the buyers back down, right? But if the cannonball lands inside the fortress, so imagine a line. There's a resistance line, and the cannonball got fired, and it goes inside and lands inside the fortress. So what will happen? All the people over there, they just get killed, right? So all the sellers, they just run away. All the stocks got hit. So everybody is looking for short covering because they know now, okay, we are losing the battle. So when you think like this, when we have a red target and the market is gapping above the red target, then I send a immediate revised red target, or even if it's gapping up yellow, especially red. So if I see a gap up happening during pre-market, so I'm watching. I live in California. I wake up at 5 and I'm watching all the pre-market action in open position and overall the futures market and everything. So I see there's a gap and I send a pre-market alert saying that, okay, this market is will gap up. Chances are high it will gap above red target. So hold it. Or maybe I send out at 6:31 Pacific time that hold this because it's gap up. So this is what's happening. I'm looking at the gap above the red target, and it's a brand new opportunity to hold or add even more to the trade. So that's a brand new opportunity. So similarly, if you apply the same concept, gapping below the red target for the puts. So for the puts, if we have puts trade, and let's say we bought it at 15 puts, we shorted the market at 15, and the red target is 10. But today, the market when opened, it gapped below 10. So if it gapped below 10, let's say it gapped down at 950. So it gapped down at 950, and then I'm seeing it, and I'm saying, okay, it gapped down below 950. It better come back. If we have a put, so we are lucky, we have more money. But if it doesn't come above 10 right away, like within 30 minutes, then the chances are it's going further lower. So I revise the target for the put. So I send you the revised target for puts to hold for further gain. And then if we revise it and if it comes back above 10, then we close it. That was our target. So that's the reason I'm sending out the revised target for the red. So gap up, gap below. So where the cannonball is getting fired and where it's landing. So we covered. I showed you some charts, and I showed you. I gave you the trade messages. I intend to hold these webinars every 2 weeks. Now, about the market, the Nasdaq gave like a bounce. So the Nasdaq was trading down, and S&P, Dow Jones, and especially Dow Jones was breaking out. S&P was following. So Dow Jones made a new high. S&P is about to make a new high. Hopefully, Russell is following it third. Nasdaq is way behind, but Nasdaq made a key reversal last week. So, but then gap down on Friday, and then I send the alert to the to our members that this gap down has a reversal. So gap down reversal will occur. So it means after it's gap down, it's expected to go back up. But then we have a resistance level in Nasdaq, which is a Thursday level. So Thursday level is the resistance level. If it goes above and the Dow Jones make another new high above 32,800, 32,900, market is expected to move higher. So I don't know what will happen, but this is the reading of the market. So let me answer some questions. We have been talking for a while. Okay, so let me read your question. There's so many. So win-loss ratio. Okay, so people ask me, okay, what is your typical win-loss ratio? Like Santosh asked. So this is a wrong question to ask. Win-loss ratio. This is a wrong question to ask because I can say like 2-3 weeks ago I said that okay, what if I say I have a win ratio of 90%, 99%? So if I say I have a win ratio of 99%, does it mean I'm a very good trader? No, I may not, because 99% win ratio doesn't mean that I'm coming out. It could be that the 99 I'm making let's say $1, and then on one trade, so 99 trades I put, I made $1 on it. So overall I made $99. But on the one trade which I lost, I lost $100. So overall I'm a loser. So don't look for the win ratio. This is not the right question to ask. Look for win ratio, not only the win ratio. So ask, what is your average percentage gain? What is your average percentage loss? How long the trade you stay in the trade? Do you provide updates to add more? So because I provide constant updates. So it's up to you to take advantage. It depends on you, on your portfolio size and who you are. So all that. If I say, okay, I just trade one trade a month, so and I make 100%, or if I say I take 4 trades a month and I make on average 50%. So which one is better? The one only one trade or 5 trades? So what is the frequency? What is the churning rate? So all this, when you combine all that, then you can say, okay, this service is good or not. So just a win ratio is not good. So this is not. What method do you use to find your trade? Yeah. So what method? So it's all handpicked. Like you sometimes you go and handpick, like handmade rugs or things like that. So on I have a pre selected stock basket. So then I sort it based on the net change. So during the day I'm sorting it on the net change basis whether I'm looking for up and down trade, and then I'm keeping the chart on my screen, and then I'm going through what is happening. And the pulse, so it's like reading the pulse when the stock is moving in front of you on the screen. So you're not watching any chart. I'm not watching any chart. I'm looking at the price move. So it's blinking, it's moving up and down, up and down. So you can feel the rhythm, and then you click on it, and then you see the chart, and then you decide. So I do that. So the recommendation to swing light is same as swing service. So swing light is a subset of swing. So swing light is a subset of swing. So what happens, the reason I created swing light is this. There are some members who are busy, so they cannot take all and they have a smaller portfolio size. So swing light is a subset of swing. and I try to send the trade in the swing line $5 and below, and lesser trade. So the swing line has a lesser trade. Swing has most of them, and it can be $16 option trade, $2,000 option trade. So because I have members who have a $15,000, $25,000 portfolio, and they have millions of dollars. So they can eat all kind of things. So they say, okay, throw at me anything, and I will absorb. So they do that. So there is a difference. Which charts do you refer? 10 minutes, 30 minutes? So I'll explain the time. It's too long now. So I'll explain. So just Ankit, you hold this question. So I'll explain different. I'll create another webinar on time intervals. So it takes time to explain the time intervals. Let me. I'm going from below to up. If you didn't get alert on SMS, then so we prefer Gmail. So Gmail is the most reliable, we notice. And then if you have not received SMS, then just contact the support. So contact the support, please. So we will set up the SMS. Let me read another one. What should be the ratio when everything? Let's say you bought 4 first. What should I ideally? Yeah. So okay. So if you bought 4 contracts, then so you bought 4 contracts. Let's say at $5 each. So now if you're averaging down, so you take the original dollar amount you invested, it has to be some dollar amount below the original. And then, so if you invested $2,000, the next time you're buying is $1,000, investing another 1,000, and then this $1,000 is bringing in more contracts compared to, because you're buying at the lower price. So your next unit is at the price, less price than what you bought before. So keep that in mind. And then you're not next time when you're adding it less dollars. And I also add more average up. So it's not only average down but average up also. I do not trade options. So we have a stock trading service. It's called Tiny. So if you don't trade options, you can join the Tiny stock service. So we provide a stock service. Just a second. So setup of 500 stocks, I go through handpick. So I sort it first. So I will explain the opening range breakout in one of the next webinar. Opening range breakout. So I apply opening range breakout concept. I'll explain later. Another thing. Okay. So expiration. Yeah. So expiration, usually I prefer at least 50 trading days. So 50 trading days, not calendar days. So 50 trading days. So it means right now, even the May option has less than 50 trading days. So it depends how many positions we have open, any event about to occur. So we need to buy option beyond that event. So if we get the pullback, then we don't suffer. We still have time. So ideally for now, right now is June option. I have one member who if I say buy June, he goes and buy August or September. He gives extra 2 months. And if I say buy strike 100, he goes and buy 2 strike deep in the further down. So in the money. So he's buying 2 strike in the money, and then he's buying extra 1 or 2 months, and then he's having a good time for last 4 years. So something to pay attention to. Buy extra time, and then 1 or 2 strike deep in the money, so you don't incur the time decay. So I have trade station. So I use trade station to do my trading. I do trade station. Just a second. So I don't use any indicator. So and there's no, I don't know if indicator to calculate support and resistance. So I showed you the chart. So I use the technical analysis and the turning point. So turning points are the one I use. So I look at the turning point, previous turning point. Yeah. So it's saying so some trades do last 13 days, 16 days on average, and some go to 30 days. So that's why I buy extra time to cover those exceptions. So what is the general percentage? So 65 and more is the percentage, but even the option can go down to 80, 85%, and then recover because technically it's still there. Is still in the stock is still trading within the technical zone, and the option is trading at 85% loss because of the time decay. It's just in a congestion zone, so it's just moving sideways. So if the stock is moving sideways, it is not giving you any exit signal. So you need to hold in 85%. 85% loss can turn into 4,000% return. It happens. It's not all the time, but it happens. It happened in one of the trades. It went. We bought at $1.90. So imagine buying an option at $1.90. So if the stock goes 2-3 points down, from $1.90 it will go to 80 cents right away. And if you buy a 50-cent option, you will see option dropping to 5 cents. So you should be willing to lose all when you're buying an option, 50 cents or $1 or $2, $3, because a little slight move and the option goes down. So if you say to yourself, okay, I'm willing to lose all because there's this. So it means you're starting your position at 100, imagining that 100% loss. So you will invest accordingly, assuming that the 100% loss in this trade can occur. So when you have that, then you'll be fine. But you're not planning to have 100% loss. Okay. So thank you, and we will have another webinar in 2 weeks, 3 weeks, and I'll cover time frame, multiple time frames, and I'll cover opening range breakout. All right. So thank you for coming, and the technical glitch next time I'll make sure. Thank you. I'll see you. Bye.